So if I told you that on the exact same day, um, biotechnology essentially cured a major cancer and the stock market had this massive relief rally, but at the exact same time, the Federal Reserve was quietly panicking and the U.S. government had to step in and bail out the bond market, what would you say?
I'd probably say it sounds like, I don't know, the setup for some dystopian financial thriller where the author just couldn't decide on a single plot line.
Right. That is exactly what I thought too. But, looking at the massive stack of market research and, well, the post-market data you sent us today for Wednesday, August 19th, 2026, that is our actual reality right now.
Yeah, it really is.
And our mission for this deep dive is to basically synthesize all these notes and unpack how these completely contradictory events are happening at the exact same time. Because, I mean, we're looking at a market that is telling like 5 entirely different stories simultaneously.
Exactly. And the overarching theme in all the data you've compiled here is a deeply fractured reality. Because beneath that sort of surface level calm of the major indices, there are these massive structural shifts pulling the economy in totally opposite directions.
Yeah, so let's actually start with that surface level calm,
Huh.
just to set the table for everyone. Because the market did finally exhale today after what was, honestly, a pretty brutal, tense week.
Oh, absolutely.
The S&P 500 snapped a 3-session losing streak,
Yeah.
pushing past 7,700. It closed at 7,715.42, which is roughly 1/3%.
Right.
And the Dow climbed about 65 points to 53,408. And the Nasdaq managed a tiny gain, ending around 26,342. But, reading those broad numbers, it feels like looking at the cover of a book and assuming, the entire plot.
It's incredibly deceiving. I mean, the broad view usually is, but today, especially, I've been categorizing today's session as a tactical recovery, but one that is heavily, heavily skewed by intense biotech euphoria.
Biotech euphoria, right?
Yeah, and that specific terminology matters because it signals that if we don't look beneath those broad index numbers, we completely miss the actual mechanics driving the tape today.
Well, then let's jump straight into that biotech euphoria, because based on the articles in our stack, this was the undisputed showstopper today.
Without a doubt.
I mean, this is the primary engine that kept the Dow out of the red. It drove the entire healthcare sector up almost 3%. And the star of that show was Moderna, ticker mRNA.
Yes.
The stock surged an unprecedented 125.9% in a single session.
Which is just staggering.
Right, we are talking about a mega cap company, literally a household name, more than doubling its value in a matter of hours.
Yeah, and the catalyst there was a landmark phase 3 trial success for Intismeran. That's their mRNA cancer vaccine, specifically targeting melanoma, and the ripple effects were immediate.
Oh, I bet.
I mean, their development partner, Merck, ticker MRK, jumped over 11% on the news, and then BioNTech, ticker BNTX, which is their primary rival in the mRNA space, they gained 21%. In what the street calls a sympathy rally.
Wait, a sympathy rally. Let me make sure I have that straight. That basically means investors see Moderna win, and they just assume BioNTech will too, simply because they use the same underlying technology.
That's the basic premise, yeah. But the underlying logic is much more profound than just blind optimism.
Okay.
When one company makes a breakthrough of this magnitude, it validates the biological mechanism for the entire field.
Well, let's actually dig into that mechanism if we can.
Yeah.
Because the articles mention the cancer vaccine, but they kind of skim over how it actually works.
Right. They assume a lot of prior knowledge.
Yeah, and I mean, a few years ago, mRNA technology was this miraculous tool that pulled us out of a global pandemic. It was an engine designed for a very specific type of vehicle, fighting a virus. So how do you take that exact same engine and use it to build a hyper-advanced sports car that hunts down cancer?
So to understand that leap, we have to look at how mRNA fundamentally operates. Traditional vaccines typically use a weakened or dead virus to trigger an immune response, but messenger RNA is entirely different.
Right, it's just code, essentially.
Exactly. It's literally just a string of genetic code. It's a set of instructions. So during the pandemic, the mRNA instructed our cells to build the spike protein of the virus, and that trained our immune system to recognize and attack it.
So it's kind of like handing the immune system a wanted poster.
That is a perfect analogy. But cancer is infinitely more complex than a standard virus because cancer cells are, they're your own cells that have mutated. And because of that, they are incredibly good at hiding from the immune system. So what Moderna did with Intismeran for melanoma is they actually sequenced the DNA of a patient's specific tumor.
Oh, wow.
Yeah, they identify the unique mutated proteins, which are called neoantigens, that are present only on the cancer cells, not on the healthy cells.
Oh, I see where this is going. So they write a custom line of code based on that specific patient's tumor.
They do. They create custom mRNA instructions that tell the patient's body to produce those specific neoantigens. So when it's injected, the immune system's T cells suddenly recognize these proteins as foreign invaders.
That's incredible.
The mRNA essentially programs the T cells to aggressively hunt down and destroy any cell displaying that specific tumor marker.
So it is literally programming the human immune system to recognize a highly specific mugshot of the cancer.
Yes.
Man, that completely explains the BioNTech surge. Because this isn't just a win for one drug. This proves that the concept of programmable medicine actually works on the hardest disease we face.
Exactly. The market is recalculating the probability of success for every single mRNA pipeline drug currently in existence. I mean, for years, the scientific community had this theoretical thesis that it could work.
Right. In theory.
But today, that thesis became undeniable, peer-reviewed Phase 3 data. The ceiling for the entire biotech sector has fundamentally changed.
That is amazing. But, while biotech is having this beautiful, unified moment of triumph, saving the world and all that, the technology sector is experiencing the exact opposite.
Very true.
Because while going through the semiconductor research you sent us, it felt like reading dispatches from a zero-sum turf war.
The contrast is striking, honestly. Tech is currently a battlefield.
Yeah, because earlier in the year, anything with the letters A and I attached to it just went up together. It was a rising tide lifting all boats. But today, we saw a massive divergence in the custom silicon space.
We really did.
Marvell, ticker MRVL, surged nearly 10% after securing a massive custom AI chip deal with Alphabet, Google. But on the flip side, Broadcom, ticker AVGO, fell over 4%. They were facing brutal selling pressure all day.
Yeah, the narrative in the artificial intelligence trade has completely fractured. We've entered a phase of cannibalization. I actually view it as a chip civil war.
Okay, a chip civil war. I want to understand the underlying engineering challenges here, because for the longest time, it seemed like NVIDIA was the only arms dealer in town, right? Just selling off-the-shelf GPUs to everyone. So why are companies like Google suddenly obsessed with custom silicon to the point where it's causing this civil war between Broadcom and Marvell?
Well, it really comes down to power consumption and operational efficiency at hyperscalers.
Wait, intercepting you right there. By hyperscalers, you mean the massive cloud infrastructure providers, right? Like Google, Amazon, Microsoft, the ones operating data centers the size of small cities.
Yes, exactly. Those hyperscalers were the ones buying up all the NVIDIA GPUs. And those general-purpose GPUs are fantastic for the initial training phase of a large language model.
Okay, the training phase.
Right, because they can handle a massive variety of complex calculations simultaneously. But once the model is trained, you move to the inference phase. And that is when millions of everyday users are actually querying the AI.
Okay, so training is like going to the gym and learning the skill, and inference is actually playing the game on the field.
That's it. And running inference on a general-purpose GPU is incredibly inefficient. A single AI query can use up to 10 times the electricity of a standard internet search.
10 times, wow.
Yeah, so if Google tries to run billions of AI queries a day on off-the-shelf hardware, the electricity costs alone would destroy their profit margins. I mean, their data centers would quite literally melt from the heat generation.
Jeez. Okay, so that brings us back to, like a tailored suit analogy. An off-the-rack suit works fine for a generic event, but if you are going to wear it every single day for a highly specific job, you need one tailored exactly to your measurements.
Exactly. And in this case, the tailored suit is an application-specific integrated circuit, or ASIC.
Okay.
It's a custom chip designed to do exactly one type of mathematical calculation perfectly, and it uses a fraction of the power. Historically, Broadcom has been the undisputed king of that custom silicon tailor shop. They had the intellectual property moat.
But the news today is that Marvell just swooped in and took a massive piece of Google's custom chip business.
Right, which shows that Broadcom's moat is eroding. The territory is highly contested now. When Marvell wins a contract, Broadcom necessarily loses a revenue stream.
I see.
So that drop in Broadcom stock is the market pricing in a brutal new reality. These chip designers are going to ruthlessly encroach on each other's market share just to survive the next phase of the AI infrastructure build-out.
That makes total sense. So tech giants are burning billions in a zero-sum chip war, and biotech companies are rewriting genetic code. But let's step out of the corporate boardrooms and look at the real-world economy for a second, because the contrast is fascinating.
It really
The
is.
actual economy is seemingly being propped up by something much simpler, which is people buying throw pillows at Target.
The consumer pulse remains the ultimate wild card in all our macroeconomic models, honestly.
It's crazy, because based on the constant recession warnings in the news cycle, you would think every day people are hoarding cash and battening down the hatches. But Target, ticker TGT, closed up nearly 4% today following their Q2 results.
Right.
And the most compelling part of their earnings report wasn't just the top-line revenue. They specifically highlighted a return to discretionary spending growth and vastly improved inventory management.
Yeah, and that phrase, inventory management, that is the Rosetta Stone for understanding the retail sector's recovery right now. Yeah, because for the past 2 years, major retailers have been severely punished by the bullwhip effect.
The bullwhip effect. Walk me through how that actually plays out from like the factory to the store shelf.
Okay, so imagine a supply chain as a long whip. A small flick of the wrist at the handle, which represents consumer demand, creates a massive chaotic wave at the very end of the whip, which is the manufacturing floor in Asia.
Right, okay.
So during the supply chain crunches, retailers panicked because they couldn't get inventory, so they overordered everything.
Oh, right. They were essentially guessing what consumers would want 6 to 9 months in the future
Yeah.
and just ordering double just to be safe.
Exactly. And by the time all those shipping containers finally arrived and unloaded at the distribution centers, consumer trends had shifted again. So Target ended up with warehouses packed to the ceiling with, bulky patio furniture and athleisure wear that nobody wanted anymore.
Yeah, the pandemic staples.
Right. So to clear that bloated inventory, they had to implement massive discount sales, which absolutely crushed their profit margins.
But, I have to push back on the optimism here for a second. Are we sure Target is actually seeing sustainable growth? Or did they just, finally manage to liquidate all that leftover pandemic patio furniture,
Yeah.
making their margins look artificially better this quarter?
That is a vital distinction to make. But if it were just liquidation, we would see revenue flat or down while margins improved. But Target specifically reported growth in discretionary spending.
Oh, okay.
Yeah. That means consumers aren't just buying groceries and household necessities. They are actively choosing to buy the non-essentials, the fun stuff.
Right. And looking at the after-hours tape from your notes, it's not just retail holding up. Even niche tech and manufacturing companies are
Yeah.
defying the gravity of a slowdown.
Yep.
I mean, we saw Datavault AI, ticker DVLT,
Yeah.
nearly triple their revenue year over year. That's a 287% surge, keeping their full-year targets entirely intact.
Huge numbers.
And Nordson Corporation, ticker NDSN, their early numbers are showing massive strength in their advanced tech division, just completely blowing past analysts' expectations. Oh, and a quick correction from the notes provided. The morning whispers were actually wrong. Ross Stores, ticker ROST, is officially reporting tomorrow, Thursday, not today.
Okay, good catch. But yeah, the resilience is broad-based. The late summer U.S. consumer still has a financial buffer. Employment is hanging in there, and people are willing to open their wallets for things they want, not just things they need.
So the consumer is keeping the ship afloat, and the stock market is cheering. But let's pull back the curtain on the final stack of documents you provided, because this is where the story gets really dark.
It does.
The foundation of the economy, interest rates, and the Federal Reserve is showing massive structural cracks.
We are witnessing the ultimate divergence between microeconomic success and macroeconomic fragility right now.
Yeah. So the July FOMC minutes were released at 2:00 p.m. today. The Fed held rates steady at 3.5 to 3.75%. But the vote wasn't unanimous. It was 9-3.
Which is incredibly rare.
You had 3 hawkish dissents, Logan, Hammock, and Kashkari, all formally demanding immediate rate hikes. I mean, the Federal Reserve is usually this monolith of unity. Finding out there's a 9-3 split feels like coming home to find out your parents are having a vicious screaming argument in the kitchen about the mortgage, while the kids, meaning the stock market, are happily playing in the living room, totally oblivious to the tension.
That is actually a brilliant way to put it, because the gravity of a 9-3 vote in modern Fed history is severe. The Federal Reserve uses consensus as its most powerful psychological tool to stabilize markets.
Right, they want a united front.
Exactly. When the chairman speaks, he speaks for the entire institution. So for 3 regional presidents to officially break ranks and permanently attach their names to a dissent, that means the internal debates aren't just disagreements. There are ideological battles over the trajectory of inflation.
Wow.
The hawks are looking at the sticky inflation data and realizing that if they don't hike now, the base effects are going to wear off by October and inflation could reaccelerate. The committee fundamentally does not trust the current economic data to stay stable.
But this is the part of the deep dive that really broke my brain today. Because with the fractured Fed openly panicking about inflation and threatening more rate hikes, basic economics dictates that bond yields should spike.
Right.
But the 10-year Treasury yield actually dropped today, falling 6 basis points to 4.65%. And it didn't drop because of some magically good economic data. It dropped because the Treasury Department stepped in and doubled its debt buyback program to $4 billion.
Yes, the bond bailout.
Right, they artificially injected liquidity into the long end of the curve. You mentioned in the notes they're buying back older off-the-run debt. Let me pause there. Off the run. You mean older bonds that the Treasury issued years ago, as opposed to the new bonds they are actively auctioning today?
Correct. The newly auctioned bonds are called on the run, and they are highly liquid. Everyone trades them.
Right.
But as those bonds age, they become off the run. And they usually end up sitting in the buy and hold portfolios of pension funds and foreign governments.
So let me get this straight and figure out the mechanics here.
Yeah.
If those older bonds are just sitting in portfolios, dealers end up with too much inventory when they do try to trade them, and the liquidity just dries up.
Yes.
So the Treasury is stepping in to buy its own older debt. It's like a company secretly buying its own product off the retail shelves just to make its sales numbers look good. Except, in this case, the U.S. government is buying its own debt just to keep the foundation of the global bond market from completely seizing up.
That analogy captures the artificiality of it perfectly. The Treasury had to become the buyer of last resort because there's literally weren't enough natural buyers in the open market to absorb the supply.
That is terrifying when you actually stop and consider the implications. I mean, equity investors look at their trading screens, they see the 10-year yield dropping, and their algorithms immediately say, buy stocks, the cost of capital is going down.
Right. They're celebrating the symptom, which is the lower yields, while completely ignoring the disease.
Yeah.
A deeply strained sovereign bond market that requires emergency, multi-billion-dollar government interventions just to function normally is a massive flashing warning sign.
It really is. So we have a historic biotech rally curing cancer and a cutthroat AI turf war dominating the headlines. And they are acting as this beautiful, shimmering smokescreen for the fact that the people controlling the money supply are literally fighting with each other, and the bond market is on life support.
Which sets an incredibly tense stage for the rest of the week, to say the least.
Yeah, looking at the map for tomorrow, Thursday, it is densely packed. In the morning, we get weekly jobless claims and the Philly Fed Manufacturing Index.
Yep.
Then after the bell, we finally get Ross Stores, and more importantly, FedEx. And FedEx is essentially the ultimate litmus test for global trade velocity, right? Because if packages aren't moving through their network, nothing is moving in the broader economy.
Exactly. FedEx will tell us if Target's discretionary spending bump is an anomaly or a macro trend.
Right.
And all of this is really just a preamble to next week's Jackson Hole Symposium. Chair Warsh is going to have to stand at a podium and somehow bridge the massive intellectual gap between a cooling labor market and the sticky inflation that forced those 3 Fed presidents to dissent today.
Man, I do not envy the position he's in.
Not at all.
Well, we synthesized a lot of complex material from your sources today. From the miraculous biological mechanics of mRNA vaccines, to the ruthless power efficiency demands driving custom silicon, to consumers somehow keeping the retail sector afloat, all while the Federal Reserve fractures behind closed doors.
The contrast between the optimism in technology and the distress in monetary policy is truly the defining characteristic of this market right now.
Yeah, it really is. And as we wrap up this deep dive, I want to leave you with a final thought to chew on.
Right.
Think back to that broken thermometer we talked about.
Right.
If a historic 125% biotech rally and an exciting AI turf war can successfully mask a deeply divided Federal Reserve and emergency Treasury interventions, well, how long can this market's tactical recovery actually last before macroeconomic reality finally bites back?